Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research Team. And in this episode of our Fireside, I'll be talking with Stuart Oakley from the FX Trading Desk, our global head of FX flow trading, on what to make of the recent moves in both the dollar and Chinese renminbi, and also his thoughts on the broad FX market. I'll be asking Stuart if he thinks the recent dollar weakness will become a multi-year trend, if the Chinese renminbi can sustain its recent outperformance, and what developments he expects to see in the long term for foreign exchange. Now, it's worth noting for listeners that Stuart is from the FX sales and trading side, so he's not a part of the independent research arm like myself, and he's at the coalface of trading FX. But Stuart, just so our listeners know a little bit about yourself and what it is you do at Nomura, just how long have you been currently trading foreign exchange and rates for?
Hi, Jordan. A fairly long time, actually. Well, I started in '95 at Credit Suisse as a rates trader, always in emerging markets, trading EMEA rates. And then I worked at Barclays. And then in 2010, after 15 years of working in the London markets, I moved out to Asia, where I worked briefly at RBS, and then I joined Nomura. And really the last 15 years, I've been very much focused on FX and in particular, Asia.
Well, okay, Stu, clearly years of experience going into this then. Let's talk about the markets. We're currently recording this a day after that news yesterday from the vaccine of Pfizer, and markets really have moved as a result. We looked at the results. We had a 90% efficacy rate of that trial and all the other nerdy details. And I have to admit, it's pretty good news, and it does raise hopes for other vaccines as well in the pipeline. And we might be able to say that this will be the last winter of lockdown. But markets have moved a lot, Stu. And I've got to say, yesterday, for some markets, it wasn't good news for everyone. We had a big sell-off in those consensus lockdown trades in equities. But there were, also in FX, the consensus moves, the consensus trades did underperform. Even the trades where we thought they would do well with a vaccine didn't perform yesterday. And it could be that classic buy the rumor, sell the fact moment in trading that we see all the time. Or maybe it's because the market's crowded. So I want to ask you about the dollar and positioning and so forth. Do you think what we saw yesterday was something that we should reflect on, and maybe it's a new higher dollar trade? Or do you think that this dollar weakness trend that we've been trading for a while has more to go?
I would say it's way too early to call a turn in the dollar. Way too early, although the news was clearly very positive yesterday. You're absolutely right in your assertion that the short dollar trade has been very crowded, and that was very much responsible for some of the sharp moves higher in the dollar that we saw yesterday. But there's a clear reason why it's been a consensus trade for so long, particularly against Asian currencies and specifically against China, actually. Let's be clear, the biggest driver of the dollar will always be yield differentials. And as we know, that yield advantage is being completely eliminated this year. Of course, there's been many other factors like the way Asia has dealt with the virus in a better way, the widening US fiscal deficit, reserve managers diversifying away from the dollar. All of these things have led to dollar weakness, justifiably so. But I would say it's, super soft monetary policy via QE in the US that trumps everything else. So are we going to get a reversal of that super soft monetary policy? I think the answer is absolutely not right now. That's something that I wouldn't expect to happen until many quarters from now.
Well, part of the move yesterday was not really an FX story. It was that rate story, Stu, wasn't it? So US real yields went higher, the curve steepened up. What's the sort of view from the desk there for the sort of direction in rates here?
I think it's tricky, actually. I mean, we're waiting for Powell to speak tomorrow to see if he says anything about the rise in the Treasury curve. I think sentiment is everything in the very short term. And if we see 10-year treasuries above, that big 1% level, then it's probably going to put a bid under the dollar in the very short term. But I think beyond that, there's still too many overwhelming factors that will allow the dollar to appreciate. And, let's remember that, a vaccine, yes, it could lead to, consumption spending going up and growth and inflation further down the line and rates going up in the US. Yes, that's absolutely true. But it also benefits, many other countries as well, particularly those that, benefit from travel, tourism, all the open economies that export to the US. So I don't think it's as clear cut that the dollar will be the big winner in the vaccine.
And there's the other story, which is flows. So we can talk about vaccine macro impact. Have you noticed any change in the way that dollar flows have behaved? Not just in the past day. I think that's just too short to tell. I'm thinking more about pre-COVID. There was what we called the dollar milkshake trade. It was higher dollar, higher US equities and long US rates. That's kind of changed now, hasn't it, Stu? Post-COVID, so in this situation we are in today, before the vaccine news, the dollar was underperforming, US growth expectations falling compared to peers. Have we seen the macro story feed through to a change in the sort of flow story that, like, you see from corporate FX hedging, for example? Are we seeing European investors, for example, start to hedge their dollar exposure quite a bit more, especially since we've seen a collapse in US yields?
Well, you mentioned flows, and FX is all about flows, okay? And I think the really big flows that have given the dollar direction this year have been from central banks. Actually, they're the biggest players of all, as we know, and there has clearly been a move away from the dollar into other currencies. The euro, the yen, China, I think have been the big beneficiaries of that. So they're the most interesting flows. Whether asset managers, big pension funds have been following suit and moving away from the dollar as well, there's lots of anecdotes that has started to happen, although I think we're yet to see the data on that.
Well, let's talk more about Asia, Stu. So CNH has been one of the outperformers this year. It's been a long trend lower in dollar CNH. Is this something that you think is too consensus of a trade to keep going, or are there more upside in CNH trades to come?
Well, there's a few nuances when you trade dollar China, and particularly this move that we've seen. And the first one I would say is it's entirely led by the onshore market. Dollar China is not a market that's really dictated by speculators or asset managers or financial flows necessarily. The onshore spot market is far bigger than the offshore dollar CNH market. And to that end, there has been a huge amount of Chinese corporates selling dollars. The export data has been fantastic. Exporters, we hear, have been increasing their hedges on dollar receivables, which basically means they're in a rush to sell more of the dollars that they take in. And that has been the primary driver of dollar CNY, thus dollar CNH, to go lower. And then there's several other factors as well. I mean, firstly, there's billions of dollars of foreign capital going into China. Unsurprisingly, I mean, you've got a 10-year treasury bond in China, which gives you, more than 200 basis points than you would get in the US, for example. When you've got a currency that's on an appreciation path, that's always going to attract foreign capital. Same story with the equity market as well. The macro story in China is very, very strong. And then lastly, I would say the monetary authorities there, the PBOC, seem to be fairly comfortable with a currency that is gradually appreciating. And, if they give this move their endorsement, I think that will give a lot of confidence to the market.
What sort of confidence, Stu? Are we talking 625? We're currently trading at 660 in CNH, for example. Are we talking 6? What sort of levels do you have in mind? Let's talk over the next year.
Yeah, I don't think the currency can appreciate that much. I mean, bear in mind, we've gone from 720 to 760. So that's, roughly 8.5%. And that's happened over several months. That's quite a sharp move. And we know that the PBOC like to manage their currency against its trade-weighted basket, and that the currency is also significantly strengthened against this basket. I mentioned earlier that the PBOC seem very comfortable with a stronger currency, but what we know that they don't like is it when it appreciates too quickly, because obviously, that can impact exporters and their competitiveness. So I think the move continues where dollar CNH goes lower. I think it'll happen at a far more gradual pace. And I think the landing spot will probably be 640, maybe slightly lower than that. I know there's several people speculating that it could go all the way down to 620. I would say for it to move that far, you have to have a lot more broad-based dollar weakness, which would mean euro dollar significantly higher than where it is now. Indeed,
the euro dollar is very tightly correlated to what's happening in CNH as well. But Stu, I looked at the price action yesterday. At one point, the market was very nervous. In FX, we had some dollar strength creeping in. And dollar CNH was one of those we were all focused on, of course. It looked like yesterday could have been a move that would trigger stops that would make the move higher in dollar CNH self-fulfilling. It's kind of calmed down today. Is that good news in your view? Does that tell you that maybe the positioning isn't so crowded? Maybe the folks involved are not so sensitive to the small price action? Or do you think there's some potential pain for CNH positions because it's quite overcrowded?
Well, if we look at the dollar generally since the vaccine news came out and look at how currencies have performed against the dollar. Now, the worst performing currencies are gold, yen, and euro. As you'd expect, they're low yielders. And then you've got CNH, and that was probably a function of very crowded positioning. And the positioning is indeed very, very crowded. And the currencies that traded, have traded really well in the last couple of days that have really held in have been Mexico, Thai baht, Korea, IDR. They're going to benefit from a vaccine and renewed growth in the US. With China specifically, as I just mentioned, it's driven by the onshore market. And I'm fairly confident in saying that if dollar CNY were to trade back up through 665 up towards 670, I would expect a wall of dollars waiting there to be sold by onshore corporates and exporters who seem to be holding way more dollars than they're comfortable with.
Well, that's a good news then for anyone holding a long CNH trade, but there's a few other risks. So there's the flow risk, which we just talked about there. Then there's also the political risks as well.
There's what Joe Biden would do with China.
Will we see the US tariffs or the phase one deal change in any way? What's the sort of thoughts there from the desk? Do you think that US tensions with China could be that potential risk down the line?
Well, that's something definitely to be mindful of. I mean, as we saw in 2018 and 2019, when President Trump imposed tariffs on China, we had a material move higher in dollar CNH. The PBOC seemed very happy to allow their currency to weaken to offset the effect of the tariffs. And we traded from 640 all the way up to 720. So we know the damage that tariffs can do on this currency. So then the question becomes, what is the probability that Biden is going to be as hawkish towards China as President Trump was? And I think we're all of the belief that it's very unlikely he'll be anywhere near as hawkish. And it's certainly not our base case that we're going to get more tariffs coming from Biden.
Well, let's move away from the focus on China and look towards the rest of the EM complex, Stu. Let's talk about the back to normal vaccine trade. I know it's still a while away, but it could be next summer or even autumn when hopefully there's enough vaccines rolled out that these lockdowns won't be needed and maybe tourism comes back and travel and so forth. So which EM currencies stand out for you as the current potential winners from a back to normal vaccine trade?
Well, I think, a snapshot of the last 24 hours price action will give you a fairly good answer to that. And, the currencies that have traded really well since that news came out, Thai baht, Mexican peso, Korea, very open economy, big exporter to the US, IDR, the currencies that, where there's tourism, where there's open economies and they can export to the US, they benefit from US growth. Where there's high yield to protect them, IDR, for example, India, those currencies traded quite well yesterday. They're going to be big beneficiaries. I still believe China will trade extremely well, even when a vaccine comes. And the ones that are going to get punished are the low yielders. And, as we saw yesterday, gold, yen, the euro, I think they're going to struggle.
Indeed, it's definitely a tug of war for euro and dollar here. But let's talk now less more on the short-term and medium-term market story and more about the long-term FX market developments. So in your career, Stuart, you've probably seen much more of a development between the old school voice trading in FX towards a pure electronic. FX is kind of in a transition phase towards being purely electronic in size for all products. So in your mind, what do you expect to see for the FX market's development in the next few years? And what will that start to mean for the day-to-day trading of it?
Well, there's only so much that machines can do. And I mean, obviously, it comes down to the user experience. Now, the more vanilla the product, the more end users are going to want to use machines to trade foreign exchange because it's just so easy. And clearly, we've all seen how that's developed over the last 20 years or so. For the less vanilla stuff, there's always going to be a need for voice trading, particularly, as a bank, when we're dealing with our clients that are, say, non-market professionals. Let's say we have, a large corporation that wants to hedge, a long-dated stream of cash flows in a non-vanilla currency, let's say in emerging markets. That can't be done over a machine. You're talking about tailored FX solutions that will involve optionality and expertise and advice. So there's only so far that machines can take us. But that said, the volumes in the foreign exchange world are just absolutely mind-boggling. And clearly, all the e-commerce platforms have been a big part of that development.
Well, that's a good point about the volumes, because sometimes we simplify the FX market down to how speculative traders work. So when you have a piece of news come out and that drives FX, or when you have a data point from a central bank or anything like that, that's kind of what the commentary in the FT or elsewhere would tell you about. But there's also the corporate hedging flows, there's the day-to-day trading flows, there's the gamma, there's the vol delta hedging. So Stu, what do you think is the biggest risk for FX markets right now? Because I look at the price action whenever we get a piece of news, and we have these gaps, we have periods of these flash crashes. Is that something you expect to be the new normal, something we have to get used to? Or is the FX market making changes to try and fix that problem?
Well, the FX market is very liquid. And obviously, the more liquid the currency pair, like euro dollar, for example, dollar CNH is becoming extremely liquid, dollar yen, the less the likelihood where you're going to get that excess volatility. But of course, we do get periods of excess volatility, and that normally happens when the market's position all gets caught one way, and then a bit of news comes out that's incongruent with the positioning. Beyond that, I would say ultimately, it's balance of payments flows that will dictate the direction of a currency. So, old school macro, you look at how the current account is developing, import and export flows, you look at how the capital flows are shaping up, and then you make your prediction and which way it's going to go over a multi-month period. There's a lot of noise short term, and sometimes you've got to just understand that it is all noise. It's, all the algos on the machine, all the short-term speculators. And if you want to avoid that noise, then one should, has to be very mindful of sizing one's position and also using options. So, you don't get shaken out on some of the short-term volatility, and you give yourself a much better Sharpe ratio where your P&L is not so volatile.
Well, what's the old school saying, Stu? The market can stay irrational longer than you can stay solvent. So sometimes trading through that noise can be difficult, and risk taking is always advised. The last question, I guess, Stu, is what are the main risks for the rest of this year and the trades that you're kind of looking out for?
Well, I mean, as I'm sure you figured out, we're fairly positive on China. We're fairly positive on the Asian currency complex. I think the real risk that's staring us in the face is actually inflation in the US. When this vaccine comes and when all this sort of pent up demand and consumption spending comes and it generates growth and inflation, and I'm sure there will be a huge amount of spending. I mean, I don't know about you, Jordan, but I can't wait to get out and travel and spend money and go to bars and all of that stuff. And I'm sure everyone feels the same way. When we do get a couple of high inflation prints above 2%, and the front end of the US curve starts to price higher, and people expect monetary policy to not remain as loose for as long as people were expecting it, then that's when emerging market currencies are going to face some real headwinds. Now, I initially didn't think we would be in this situation until at least Q2 next year, although this vaccine news yesterday, potentially brings that forward. There's a lot of things need to happen between, this announcement yesterday of the 90% efficacy of the vaccine to actually, being in people's hands and in production and everyone taking it and the world opening up again. But when that does happen, we just have to be very watchful of inflation data in the US, and because that is the absolute key. When treasury yields go higher, the dollar's going to go higher.
Well, Stuart, I think that's all of it for today. So thank you very much.
Absolute pleasure, Jordan. Thank you for having me on.
So those are the views from us, those are the trades from us, and that's a fireside chat with Stuart Oakley. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one, and please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.